So welcome to today's second lecture on financial risk management. Last week we stopped with our discussion of a very theoretical but also a very interesting, a very fundamental question, that is, why should we do risk management in the first place? As I've told you 2 weeks ago, from a theoretical point of view, it's not so clear and not so obvious why one should engage in risk management. First of all, we have to remind ourselves what is the ultimate goal in risk management, usually stabilization and ideally maximization of shareholder value. In the end, it all leads to a maximization of shareholder value, and everything else you can do in risk management should lead to a higher shareholder value, stabilize returns, maximize returns, prevent losses to your firm reputation, etc., etc. So maximization of shareholder value is our ultimate goal. Then, of course, it's quite clear risk management should be successful in maximizing shareholder value. And this, again, from a theoretical point of view, is not so obvious, because it could also be that firms just squander money and engage in risk management for different reasons, other than, for example, the maximization of shareholder value. So one has to ask oneself, why do firms engage in risk management? And if they do engage in risk management, is it successful? And this is the question of the irrelevance of risk management in a perfect capital market setting. Again, at first glance, this need to do risk management is intuitive, but then think again and think of different industries. Take banks, take utilities companies, take trading companies, and take, for example, the perfume shop across the street. Now, the bank does risk management. The perfume store probably does not engage in risk management. So risk management, financial risk management, is something that is special to certain industries. And if not every company, if not every industry engages in risk management, one has to answer the question, why do some firms do risk management and why do some firms do not engage in risk management? So this is the question. Again, intuitively, one could understand and one could posit that every firm should engage in risk management. We have threats to the company's very existence. We have default risk that needs to be managed. But again, do we need financial risk management and do we need a sophisticated risk management? We want to increase the shareholder value. So from a financial theory standpoint, we have to answer the question whether risk management theoretically is able to increase shareholder value. And this is quite similar to the question of the optimal capital structure in financial theory and corporate finance. Who of you has already heard of the Modigliani-Miller theorem? Who has not? Who does not know what Modigliani-Miller theorem states? Okay, you can see the irrelevance theorem of Modigliani-Miller here on the slide. In essence, what does it say? It says that under the assumption of a perfect capital market, and a perfect capital market is a capital market with no transaction costs, no taxes, perfect information, rational investors and market participants. So in other words, a capital market with no frictions. Frictions, in German we have the same word, Friktionen, which simply means that you have some deviations from a perfect capital market setting. And under the assumption of a perfect capital market, of the frictionless capital market, the Modigliani-Miller theorem states that capital structure has no influence, is irrelevant for the value of the firm, so in other words, for shareholder value. It's also sometimes referred to as the pie theory of capital structure. It simply means that if you have company A with 50% equity and 50% debt, and if you compare it to company B with 25% equity and 75% debt, the capital structure of A and B do not influence the shareholder value and the firm value of A and B, because under this setting, the capital structure decision has no influence on firm value. Why is that? You will probably learn this in the lecture by Professor Schumacher on corporate finance, Finanzwirtschaft. The general idea is that if you have a perfect capital market, investors should not care about investing in one company with a particular capital structure or a portfolio which mixes a 100% equity finance and a 100% debt financed company. And you can always duplicate this structure, this capital structure, for example, by buying 50% of the all equity and 50% of the all debt company. And if you can replicate the capital structure by simply building a portfolio of an all financed, all equity and all debt financed company, in this setting with arbitrage-free stock prices, these two strategies should have the same price. And if they have the same price, if the market is arbitrage-free, capital structure is irrelevant. So this is the basic idea. You can simply duplicate, you can simply replicate any capital structure by investing in a company with 100% equity and 100% debt. With risk management, it's basically the same result, but only a couple years later. At some point, financial economists realized that risk management has the same setting. Is risk management relevant under the settings of a perfect capital market? No. The same result here. If you have no transaction costs, if you have no taxes, a frictionless capital market, risk management cannot lead to an increase in shareholder value. Why? Again, you can simply duplicate your desired risk-return profile by investing in a risk-free company and a very risky company. And you can simply build your portfolio by picking the certain right amount of this risky and the risk-free company. So the riskiness and also the degree of risk management a company does should be irrelevant to shareholder value, and then every dollar spent on risk management is wasted because it's simply a waste of money for the investor. So why do firms engage in risk management? Quite simple. The same result as with capital structure. As soon as you have frictions, as soon as you have imperfections to your market, to your capital market, capital structure and risk management can have a positive beneficial effect on shareholder value. And here it's the same. And this is more or less the result. Yeah?
Does symmetrical information also apply towards the company and nature, for example? Because it would make sense if you do risk management for natural catastrophes.
That's a good question. I don't think this is usually included in these kinds of models. I don't think that nature and natural disasters are part of this theoretical setup. Let me just think for a moment. The investors usually have symmetric and perfect information about all the information concerning the other investors and companies. I think it's included in these models implicitly because you know about the firms and the firm values, and the firm values will reflect what can happen to the company and the risk exposure of a given company. Of course, these models are not made to withstand the sudden hand of God that strikes down on all companies and eliminates all firm assets. This is of course clear. Yeah. Now, what you can read on this slide is just what I told you about this homemade leverage and the homemade risk management. Again, under the setting of a perfect capital market, you can construct your homemade leverage and your homemade risk management by simply buying the stocks of two companies that have a different engagement in risk management or different capital structures. Now, this is from René Stuhl's book. Actually, it's on Financial Times, but it's also in a collection. A company might reduce the volatility in its share price by reducing its idiosyncratic risk, but that does not mean that its share price will rise. Well-diversified shareholders did not notice these idiosyncratic risks before the company reduced them and will not reward the company for actions that they do not notice. In the long run, the argument goes, risk management cannot create wealth because it does not increase the company's expected cash flows. It just smooths out the ups and downs in cash flow under this assumption of a perfect capital market. And this is important because this means that, first of all, theoretically, you cannot explain the existence of risk management. From this theory, it would be sensible for all companies not to engage in risk management. But you need frictions and you need imperfections to your capital market to explain the existence of risk management. And what frictions could this be? First of all, hedging cannot take place at equal cost within and outside the enterprise. So you have transaction costs, and these transaction costs differ from company to company. It's even worse than the existence of transaction costs. Next, measures of risk management can lower the probability of the enterprise's insolvency, and in the case of direct and indirect insolvency costs, risk management can thus increase shareholder value. This is the cost of distress. This is, I guess, the more frequently used term. It's the existence of financial distress costs. Now, in the setting of a perfect capital market, you assume that there is no difference between the point where you are barely above the default threshold and way above the default threshold. So there is no difference, no real difference between a company that is only marginally solvent and a company that is swimming in cash. Why? Because default is simply a barrier, and for example, if the asset value is above, you're not in default. These models do not distinguish between AAA, AA, BBB, and almost close to bankruptcy. Now, this also means that if you loosen this assumption and this restriction, and if you assume that companies that are close to bankruptcy also face so-called financial distress costs, then again, risk management can make sense. What financial distress costs can you think of? What are these? One very frequent cost of financial distress, again, remember, you are not bankrupt, but you are very close to bankruptcy, and suddenly some costs increase. Yeah? Yeah, financing costs. If you go to your bank and you ask for a loan, or if you want to issue a bond, and you're telling them you have a BBB rating, the costs of financing will be higher than for a AAA rated company. Higher financing costs. Also, something that is usually mentioned in this respect is lawyer costs. Because if you're closing in on bankruptcy, you will probably need to hire lawyers to prepare for filing for bankruptcy. So lawyer costs, financing costs, these are costs of financial distress. In the case of taxes on corporate profits, and in the case that the tax burden is convexly dependent on corporate profits, risk management can reduce the tax burden and thus after-tax profits by reducing the variability in the enterprise cash flows. This is very interesting, and I will show you this on a slide where I have a little bit more space. Okay. Now, this is a very simple argument, but I would very much like you to remember this. Assume this is the profit, and this is the tax the company has to pay on its profits. Simple assumption. First of all, how does the tax function look like? Let's start very, very simple one, a linear tax function. Let's assume we start in 0, and with increasing profits, we have to pay more taxes. Quite simple. Now, there are two scenarios actually. First of all, we have 1 million and we have 2 million euros in profits. This would mean we have to pay this in taxes. Let's call it A1 and A2. Now, we can see that we have some variability in our profits. We can either have 1 million or 2 million euros in profits. We can also do risk management, and by doing risk management, which would simply mean that we buy a derivative, we hedge our risk, we could also get a profit of 1.5 million euros. So we would have 50% probability here, 50% probability here, or 100% here. And in this case, we would have to pay B in taxes. Now, what do we have to compare? In the first scenario, we have to pay 50% probability times A1 plus 50% probability times A2, or we have to pay B. And in expectation, the expected tax is what? It's also B. Yeah? The expectation, the mean, is a linear operator. So in expectation, we will also pay B. So the expected value of 50% times, let's say 0.5 times A1 plus 0.5 times A2 is actually B. So with a linear tax function, what do we do? It's relevant. In expectation, both scenarios are equivalent. No? The expected value of B is B. The expected value of the first scenario with no risk management is also B. But why does risk management make sense nonetheless? We have to change one tiny detail. Yeah?
Tax function is different from
How does it look like, the tax function? In practice, usually.
It's a progressive tax function.
That means the function itself is convex. The function is not linear, but the function looks like this. Even if we have the same value here. This means that actually risk management will, we can also make it this, let's make it different. This is easier. Let's start here. Let's go up here. So in scenario A, with no risk management, we would still pay A1 and A2 in expectation B. But with risk management, we would only pay C here And we can immediately see that B is larger than C. So by engaging in risk management, by hedging the risk, by reducing the volatility of our profits with a convex tax function, as it is common in most tax systems, we can reduce the tax payments, which is quite simple. Yeah? I mean, if you imagine your personal income tax, and you can distinguish, you have two scenarios. You can earn 0 or 1 million. That would mean you have to pay no taxes, or 45% or 50% on a million. So in expectation, you will have to pay 500,000. Or if you can just reduce it to 500,000, but this is for sure, you will be able, with a progressive tax function and a convex tax function, you will be able to reduce your tax payments. And this is one theoretical argument in favor of the value-enhancing effect of risk management on a firm. Problem is, empirically, this doesn't work. Yeah, no company, I've not seen any convincing empirical evidence that companies really do engage in risk management because of tax concerns. They usually not. Costs of financial distress, yes. Okay, so these are some reasons for this. Next, what else can you imagine? What other reasons can you come up with that will cause firms to engage in risk management? Any idea? A very practical one. Managers are often paid in options, in stock options. And if managers are paid in stock options, these options will be worth more in case the stock price is less volatile. So the managers actually do not care about the company itself, but they want to reduce the volatility of the stock price in order for their stock options to appreciate in value. This is one frequent explanation for managers of some firms to engage in risk management, because they want volatility to be low in order to make a higher profit on their stock options. What are some consequences? Agency problems between equity and debt capital providers can sometimes lead to a situation in which an enterprise, a firm, does not execute and does not engage in investment projects with a positive capital value, net present value. In this situation, risk management can help ensure that sufficient liquidity is always available to carry out advantageous investment projects. Sometimes stakeholders may not be able to perfectly cover an increased risk of the company in contrast to shareholders. Also, big non-diversified shareholders are certainly interested in company-specific risks, so they do not want to buy something else, but they want this particular company. And the company may have a competitive advantage to cover these risks. Some shareholders or stakeholders are interested in the stability of the cash flows. They want less and lower volatility. Could also be the case. So this might be an explanation. Again, taxes, I think this argument is quite easy to understand. Unfortunately, empirically, it is usually not the case. So in summary, we can see theoretically firms should not engage in risk management. But as soon as you have frictions in your capital market, it might make sense for some firms to engage in risk management. And it's similar to the capital structure argument. And in this case, we can increase and stabilize shareholder value. Okay. I told you last time that research in this area has almost always focused on the use of derivatives. And this is still true up to this day. For example, here you can see a survey from companies and they were asked whether they use derivatives, whether they do not use derivatives, for what purpose they use derivatives. And you can see, for example, 68% of all companies in this survey, especially I think those were financials and non-financials, they only just 70% use derivatives. Smaller ones, under $1 billion total assets, they did not use derivatives so frequently. Larger firms tend to use more derivatives. And for what purpose do they use derivatives? For example, to manage short-term assets, short-term liabilities, long-term assets, long-term liabilities. And this has increased over time because financial markets have become more complex. They now offer more complex and more interesting types of financial securities. And with these additional securities, you can try to better manage your risk exposure. Again, from a research standpoint, this is quite interesting because risk management, and you will see this later on, risk management entails a lot of different things. Using derivatives, having good processes, having warning systems in place, managing interest rate risk, managing default risk. It might even be that you are, for example, the owner of a perfume store and you do a very small amount of risk management by simply calling your customers who are not currently paying their outstanding debt. If you have people who have paid by a credit card, you have a credit risk in your company. And even if you don't use derivatives, you might have some sort of risk management. But in research, in financial research, risk management is almost always put equivalently to the use of financial derivatives. Moreover, there is also one notion in research that financial derivatives are equivalent to financial innovation. What does that mean? At some point in the 70s and 80s and 90s, banks came up with new types of securities, with financial derivatives, with options, swaptions, swap contracts, futures, and then new underlyings, and so on. And there isn't too much banks and insurance companies can invent. There aren't too many innovations there. For example, back 100 years ago, some German banks got patents on piggy banks. They got different types of piggy banks patented, Sparschweine. And this is the type of innovation banks can do. Nowadays we have fintechs and we have startup companies that use digitalized banking, but even a couple of years ago, there wasn't too much innovation going on in banks and financial institutions, with one exception. They could always try to come up with new types of financial securities and financially engineered and structured finance products. This is why, in many cases in financial research, risk management tools like derivatives are also used equivalently as signs of financial innovations. And then, of course, researchers try to answer the question, has financial innovation done any harm or any good to the economy and to society as a whole? Because if you look at a newspaper, if you invite someone from our left-wing party, Die Linke, they will always tell you derivatives, they are just used for gambling, especially if they have commodities as underlying, and this is just some witchcraft that is used by evil bankers to defraud the society. Now, it's not so easy, it's not so simple, because again, these derivatives that are used in risk management, they can be seen as financial innovations. And there are numerous papers around that show that financial innovation actually has a positive effect on economy, on economic growth. And here it becomes quite clear why. Because you can use financial derivatives to hedge risk. You can make your financial positions safer, and you can prevent them from depreciating in value. but these can of course also be used for speculation. Okay. Now, for different types, for different industries, you can see that derivatives are used for hedging different risks. Banks, for example, will usually use interest rate derivatives and stock derivatives and equity derivatives. Here in the survey, you can see most of them are using them for currencies, interest rates. Some of them use derivatives to hedge commodity risk, but usually it's just interest rate and currencies. Okay. Do you have any questions concerning the theoretical background? Again, if you want to do research and if you want to write your thesis on this topic, this is usually the stuff you will be dealing with. Theoretical analysis, why do some firms engage in risk management, and is it beneficial? Because the jury is still out on the efficiency and the effect of risk management. Everyone does it, but it's very hard and very difficult to show that it actually has a persistent, positive, significant effect on firm value. Because again, risk management is also very complex, and if you don't know your tools, you will probably do more harm than good with using risk management tools. Okay, so if you have no questions, let's go to the second set of slides. Let's continue with risk types. So before coming to the very difficult but also very interesting question of how we can identify risk sources and how we can measure risk, we need to talk about all the different types of risk you can find in a company, usually a financial institution. We'll first distinguish financial versus economic and real economic risk, and then talk about the usual suspects: market price, credit, liquidity, op risk, and then actuarial risk in parentheses and model risk. But these are somehow special, that's why they are put here at the end. Usually you have market price, credit, op risk, and liquidity. Okay. Now, again, first of all, you have to distinguish between financial and real economic risk. We are talking about financial risks. We are not talking about the risk of a drop in economic growth, in GDP. We are not talking about the loss of life, the loss of employment. We're talking about financial losses. So financial risks are such risks which have their origin in investment and the financial activities of the firm, and therefore in the interaction with financial markets. So we need somehow a connection to a financial market for this to be a financial risk. Usually these risks will originate from changes in market prices, quite clear. If you buy a stock, if you buy equity, these stocks can change in prices, and then you will have a market price risk. Similarly, defaults of trade receivables or granted credit can lead to financial losses. Again, remind yourself that credit risk is not special to banks. Banks, of course, have large credit risks on their books, but even if you take, for example, a perfume store, they might have some credit risk as soon as they sell products and do not immediately cash in on their sales. The same with energy companies. They are selling energy, and you have to pay your bill at the end of the month. And energy companies have large credit risk. Measurement is quite simple. Do you know what energy companies do in order to measure the risk exposure they have in one single individual retail contract? If you have a flat, if you have rented an apartment, you will probably have an energy contract with your local energy provider. Question: what would you think is the maximum risk exposure the energy company calculates with? It definitely has measured the risk exposure it has due to the contract with you. But what is the maximal risk exposure? Yeah?
Maybe 1 month that you don't pay for, and then 40 more days?
3 months, usually. After 3 months, they will cut off electricity to you. They will send someone out, and it's quite clear you are a retail customer, so your average energy bill will be 30, 40 euros maybe. So the risk exposure is quite clear, 100, 150 euros per customer. Because if you don't pay up, after 3 months, the supply will be stopped, and they can minimize and they can limit their losses. This is different than, for example, in banking. If you have given out a loan of 1 million euros, well, you know that your maximal loss is 1 million, but it might be somewhere in between 0 and 1 million. But in this case, it's quite simple to measure the risk, the maximum risk exposure. It's more about estimating the probability that you are a customer who defaults. Okay. So again, credit risk is not limited to banks. It can also happen in industrial companies. And finally, if you have insufficient liquidity or individual assets cannot be easily sold, you will have liquidity risk. And we'll talk about this later on. Now, all these subcategories of financial risk have in common that they do not arise directly from industrial activities of the firm, but they are somehow related to cash flows. Yeah? You buy a security, market price risk. You give out a loan, then you have a cash flow, and credit risk exists. You have too little cash flows, and somehow you will have liquidity risk. So this is one common feature of financial risk. You need to have a cash flow related to this risk. Another common feature is that these risks represent a potential loss for the company. Therefore, we'll usually try to minimize or to reduce potential losses. And then a typical starting point in quantitative risk management is simply the idea that we operationalize risk by looking at loss distributions. And the question in risk management, in quantitative risk management, then is, what is the correct and what is the best estimate for the loss distribution of this particular financial risk? For example, in case X is the loss distribution of this retail contract in energy supply, it's quite simple. You have a maximum loss of 100 minus 50, maybe 100, 50 and 0. And you have to come up with a distribution. Might look like this, might look like this, and this is the task in quantitative risk management. You need to know the loss distribution, and then if you have forecasted the loss distribution, you can make some statements on how to deal with these risks. Okay. Now, real economic risk. In contrast to financial risk, real economic risk represents such risks that arise from the production of goods and services, or that concern them directly. As a consequence, they involve a number of very different threats to a company, and they might involve, for example, the entrepreneurial risk that products or services cannot be sold. And this is very tricky. Now, the risk we want to deal with in risk management is not the risk that we are going out of business. If, for example, I were to open up a shop for sausages, if I become a competitor to the many sausage sellers on the street, and my sausages don't taste well, this is my personal problem. This is my entrepreneurial risk. If I start a startup company that sells, I don't know, computers, if they don't sell, this is my risk of going out of business. This is my entrepreneurial risk. But this is nothing I can deal with in risk management. If I produce products that don't sell, this is my entrepreneurial risk and not something that is being dealt with in financial risk management. If we have a disruption of the product, of the production supply chain management, or if we cannot produce on a given machine if we have an accident, if we have fires, disasters, and similar incidents, these are usually not the types of risk we deal with in financial risk management, with one exception. We deal with these risks in operational risk management, but only under certain circumstances. Again, we deal, for example, with natural disasters. But if, again, for example, I'm selling sausages in the pedestrian zone and it's a rainy day and no customer comes by, this is my entrepreneurial risk. This is not natural disaster risk. No? Okay. Many of these risks have been summarized within the framework of the Basel II project and Basel II regulation under this name and this concept of op risk, operational risk. We'll see this later on. But these are very specific and very special. We'll see this later on. Okay. Now, let's discuss this for a moment. Can risk management help to deal with real economic risks? If so, how? But it cannot help me sell more products. At some points, this might be intertwined.
Maybe watching the weather forecast would be some kind of risk management?
Yeah. Again, it depends. For example, if you are a livestock producer, if you are in the agricultural business and you are growing wheat, might be that a natural disaster will destroy your harvest of wheat. Then, of course, you can try to hedge your risk and you can buy a financial derivative, a future contract maybe, to reduce the risk of a loss in production. You can buy insurance against natural disasters. So this is financial risk management, but this is a very special scenario, a very particular scenario. No? And it gets even more tricky when it comes to reputation risk. At the very start of the module, I told you that we are talking about financial risk management, and we are not talking about risk management in general. For example, setting up a system that prevents scandals, something like that. Yeah? Because sometimes this is also called risk management. You know, if we try to manage scandals, if we try to manage risk to our reputation, this might sometimes be included in financial risk management, but not very often. You know? But usually, real economic risks are the risks we have to face if we want to earn a profit. Okay. I brought with me some extracts from risk reports of German banks. They are in German, but I think you will get the general idea. Banks usually have a very sophisticated and very elaborate risk management in place. And they have, due to regulatory requirements, they have to report on their risk management in their annual reports. And this is an extract from the 2013 risk report of Deutsche Bank. They tell you, even with figures and numbers, where they have identified the major sources of risk. They talk about credit risk, market risk, operational risk. They also have diversification effects. And this year, Geschäftsrisiko, this is entrepreneurial risk. The risk that you are not performing well as an entrepreneur, as the owner of the company. And as you can see, they split it up into the different sections of the company. And this is what they tell you. Let's now turn to market price risks, which probably is the most important types of risk, especially in financial institutions dealing with securities. What is the definition of market price risk? Market price risks represent such risks that arise from the changes in relevant market prices and can lead to losses as a result of unfavorable price developments. They arise whenever a good produced, required by a company is traded on one or more markets, and the price of that good is subject to fluctuations. Depending on the type of goods, different forms of market price risk can be further distinguished, which are briefly outlined below. It's quite clear, as the name suggests, market price risks entail all those risks that arise due to changes and fluctuations in relevant market prices. What are relevant market prices? First of all, the prices of a security, a bond price, a stock price, any other market prices you can think of. Next simple example. Yeah?
All the assets, or can I also say
Yeah.
some minerals or metals for
Commodities. Commodities. What else? Quite simple. Currencies. Exchange rates are nothing else than prices for foreign currencies. A little bit a market price that is one would think of only indirectly as a market price. Interest rates. Interest rate management is usually considered to be part of market price risk management. Why? Interest rates are nothing else, nothing different than a price for capital. So interest rates, commodity prices, exchange rates, security prices, these are the most common security and market price risks we have. And this is quite interesting because market risk management is not really a new concept. For example, here, the idea of hedging market price risks actually goes back to ancient Mesopotamia, India, and Greece. In some cases, what these people did, they transferred and they tried to hedge the prices of raw materials, and especially agricultural products, against the natural fluctuations. And what natural fluctuations are these? Well, the 4 seasons in a year. If you are the producer of agricultural goods, you know that you're subject to all types of weather influences and the seasons in the year. And then, of course, prices for agricultural products will change during a year, and you can try to hedge these risks by selling and buying beforehand with fixed prices. And in these cases, the first commodity futures and derivatives exchanges came into place, were founded for merchants to trade these types of contracts. Do you know what commodities were traded on these exchanges? It's actually, in this case, the first examples are not from the US, but from our good neighbors in the Netherlands. First exchanges were founded in the Netherlands.
I think like these flowers.
Tulips.
Yeah.
Yeah, for example, tulips were traded on these exchanges. And also something that is not so clear at first, these exchanges also traded on shipping loads. For example, ships going to the East Indies, the West Indies, to Africa, they were insured on these exchanges, and sometimes also you were able to invest in these ships. So, for example, if a merchant wanted to take a ship to Africa and trade goods and come back to Amsterdam or Rotterdam afterwards, people started to invest in these ships, and these are the very first types of stocks, more or less, because you were able to invest in a company, and then again, this is also quite similar and resembles a sort of future contract, because you pay a certain amount of money and you hope to get a return later on. So in these situations, exchanges were founded, and it hasn't started in the 50s or 60s, but actually these exchanges, these types of securities, and also this type of hedging goes back way back in history. Okay. So this is not actually a modern invention, but dates back to old Greece, in ancient Greece. The first types of derivatives exchanges that were founded were futures exchanges. What are futures? Futures exchanges are exchanges on which forward transactions are concluded and settled, and signed and settled, and contrary to spot markets, the execution of obligations, delivery and payment from the financial contract occur only, or the execution occurs only in the future. What does this mean? Actually, in many cases, of course, futures exchanges, they trade futures. What is a forward contract? This is a very important concept here in this lecture. And what is a forward contract? Yeah?
It's basically the same as a future, but the only difference is that it's traded on the...
No, what is a forward contract?
Forward contract?
Don't define it by another definition. Don't say it's similar as a future, because I would assume that many students don't yet know what a future contract is.
Yeah,
what is a forward contract?
Two or more partners agree upon to buy or sell a certain amount of a good.
Yeah, an underlying.
Underlying to on a special fiscally on a date in the future.
At a fixed date in time, yeah?
Yeah, fixed date and time.
With a fixed
and,
maturity?
Yeah, to a fixed price.
Yeah. So, for example, we could engage in a forward contract. I'm offering to sell you 1 ton of steel with delivery on the 31st of December at the end of a year, and we both agree on a fixed price of, say, 1,000 euros. In this case, we both sign the contract. I will have to deliver 1 ton of steel, say in the port of Rotterdam, and you have to pay me 1,000 euros on this very day. What is so special about this contract? Today we fix the specifics of the contract, although delivery and payment are in the future. The difference to an option is that we both have to deliver on our contractual obligations. I have to deliver the steel, you have to pay. Neither side can choose, oh, I want out. In that case, you are in breach of contract and you will be sued. So a forward contract is the purchase or the sale of a product, of an underlying, with delivery and payment in the future. So the maturity of the forward contract is, for example, 1 year, and the underlying in this case is 1 ton of steel. This is a forward contract. What is a future contract then?
Yeah, future contract is basically the same as a forward contract.
Yeah.
The only difference that it deals with standardized amounts of goods, and it's
Two differences, yeah?
and it's on the stock exchange.
Not the stock exchange, but a future exchange.
The future exchange, and not over-the-counter markets.
Yeah. So we agreed on a forward contract. It's OTC. OTC, over the counter, means we are two partners and we are agreeing on this contract over the counter. We are dealing directly with each other. This is a forward contract. It's an OTC contract. If we standardize a forward contract, and if it is offered on an exchange, on a futures exchange, it becomes a futures contract. A future is basically the same as a forward. It's just standardized, and it's no longer OTC, but it's exchange traded. So in order for this to work, I would have to say, we are not agreeing on 1 ton of steel in this lecture hall at the end of the year, but we are agreeing on a future contract with 1 year maturity based on this particular type of standardized steel in the port of Rotterdam. So standardization is needed for this to work on an exchange, and this is a futures contract. And usually you have futures exchange, for example, the CME in Chicago, the Chicago Mercantile Exchange is the most important commodities and futures exchange. And here on these exchanges, you usually have a spot market and a futures market. On the spot market, you can buy on the spot, which means I now want to buy 1 ton of steel, I'm now ready to pay, and I now want it delivered. In many cases, these markets do not have physical settlement. So in many cases, these contracts will not be physically settled, but they will have cash settlement. What does it mean? If, for example, we agree on a forward contract, 1 ton of steel, 1,000 euros. We will wait until the 31st of December, and at that point, you will have to pay 1,000 euros to me, and we will see that the current spot price of steel, of 1 ton of steel, is actually 900. So you have bought, I think I bought the 1 ton of steel. I agree to a price of 1,000. You would have to deliver me 1 ton of steel. You can buy it at 900 on the spot market. So there's a $100 difference, and one party has to pay $100 difference to the other party, and we will not be forced to physically move around 1 ton of steel. So this is cash settlement. Yeah? And I would assume that 95 to 99% of all these contracts are nowadays settled by cash. No one wants to deal with all the steel and pork bellies and orange juice and whatever. So usually you have cash settlement. Yeah?
So if you came from real risk management into almost purely speculation now?
Yeah, that's speculation, isn't it?
No, it's not speculation. If, for example, take Daimler, a large car manufacturer. Daimler buys steel. It needs this and this amount of steel delivered to its factories each day. Then, of course, Daimler has a risk exposure to the market price of steel. Now, it could buy futures, and it could buy its steel by buying futures with physical settlement. It might actually do so. But why would it do so? It could also simply engage in long-term supply contracts with suppliers and hedge the risk exposure by additionally and cheaper buying the right amount of futures. So you simply go to the futures exchange, you buy future contracts, and you can smooth out these changes in prices, and this is not simply due to speculation. And this is what I mean with these frequent arguments by left-wing politicians, extreme, far-right, far-left-wing politicians. This is the frequent argument done by left-wing politicians. They argue that because most of these derivatives contracts are cash settled, that this is all due to speculation. First of all, no. Even if you want risk to use it for risk management and for hedging, this is still beneficial because all this steel, it's standardized. And this would always mean that you would have to go, for example, in Europe, it's usually Rotterdam. Everyone would need to go to Rotterdam to pick up the steel and oil and gas and whatnot. So physical settlement produces transaction costs that are not needed. So by doing cash settlement, you can reduce these transaction costs and you can still hedge. And by the way, speculation is not always bad. This is not supposed to be a Gordon Gekko greed is good monologue, but still, again, these are financial markets, and we would expect financial markets to reflect actual information. And what happens? I can give you a small example, a very practical one. I still remember back in my days when I was a kid, I bought computer games. Yeah? If you went to a large department store, you paid 100 euros. If you went to a specialty store, you paid 80 euros or 50 euros. So this market was highly inefficient. Yeah? Because there was incomplete information, no internet, no one knew exactly about the prices. Still, some people, some large department stores, like for example the Kaufhof, Karstadt, they were able to generate high profits of these products because they had incorrect prices. The correct market price was somewhere like today at around 50 euros. But you had incomplete markets, you had market frictions, and the result was what? People pay too much and prices were not right. Then what could happen? Now at some point people started to realize this, more shops entered the market, and some shops simply bought the products cheap and sold it at a higher price. This is what we call arbitrage. And arbitrageurs entered the markets and market prices were decreased to the fair level. And this is the same that happens here. Speculation is nothing but the process of investors making a profit of arbitrage opportunities and forcing prices to go down to their fair level. So if you see people, banks, investment banks engaging in these markets simply for speculative reasons, this is not bad per se. It might simply mean that they are forcing prices to go down, and this again is beneficial to all market participants. If you hear that some banks engage in excessive speculation, this is bad for other reasons. And if you feel that, for example, again, for example, the most important example here is, I guess, the speculation with livestock and agricultural products. We often hear this argument that large Western banks and European banks engage in speculation concerning cocoa, oil, etc. futures. Of course, in the end, this will result in lower prices, and developing countries will earn less money. But again, then prices are not right. And if these companies and if these countries engage in a world market, they will have to face world market prices. If we want to pay them more, we would need different reasons why we want to pay them more. And in this case, this trading has some negative by-effects and collateral damage, but the idea simply to stop speculation at all would be even more detrimental. So speculation, one has to be careful when talking negatively about speculation, because in many times this is beneficial for all market participants. Yeah? Okay. Any questions? Okay. Again, I'm far from being a 150% strong capitalist, but I think when it comes to financial markets, one has to be careful what is printed and what politicians tell you. The same argument, for example, with banks, what banks do and what banks don't do. If banks engage in selling products that are too risky to retail customers, I also think this should be prevented. And banks should be forced to properly inform their customers about the risk of their products. But then again, customers should also use common sense. If I go to my bank, if I read about the zero interest policy of central banks every day in my newspaper, and if I go to a bank and the bank tells me I can earn 5% risk-free, I should get suspicious. I should not trust this bank. And the same goes with an insurance company or with an asset manager, a portfolio manager, and so on. So if the story is too good to be true, one should also be suspicious, even if you're a retail customer. Okay. Now let's look at market risk in the risk report of Deutsche Bank. Here they also talk about market risk and where market risk stems from in their business. For example, trading activities. They also have some trading-related default risk. And they also have market risk from non-trading activities. For example, activities of their outside of their trading credit spread risks, investment risk, foreign currency risks, and so on. So if you want to have a closer look at this, feel free to download the current risk report of Deutsche Bank. I'm pretty sure that they now also have a large section on their legal troubles. They probably have included this now. Probably not on a market risk, but somewhere in their risk report. And they go on, and if you want to know what the absolute maximum is, you should take an annual report of a bank. Because if you take, for example, an energy company or Daimler, these risk reports will look much, much smaller. Under German law, companies are forced to report on their risks at starting at some level. So you might know this. In Germany, we have something that is called the Kontrakt, das Gesetz zur Transparenz, zur Kontrolle und Transparenz im Unternehmensbereich. So the law concerning the control and transparency in industrial firms. And this law was introduced, I think, almost 20 years ago, and it forced companies that are that are large enough and are oriented towards capital markets to have risk management in place. In many cases, this simply means they have to talk about risk management and their risk exposure in their annual report. And this will sometimes lead to a risk report that is a one-liner saying there are no identified risks in our company, full stop. And this is the full risk report. Now for a bank, especially Deutsche Bank, this is the absolute maximum of a risk report you will ever find in an annual report from Germany, because this is the behemoth of banks in Germany, and you will not find any company that has more diversity when it comes to financial risks, right? But again, if you are, for example, interested in other industries, take the annual report of Adidas, and they will probably talk about more like currency risks, you know? Because they are selling their products to foreign countries. They will probably have currency risks. Okay, and so on. They also have different types of risks, and you can look this up at home. Next type of market price risk, commodity risk. Commodity risks include potential losses arising from price fluctuations of raw materials. Commodities, what are these? Well, everything and anything you can think of. This is not a joke. Pork bellies, lard, so fat, orange juice. Has any one of you ever seen the movie Trading Places? Yeah. In German it's Glücksritter, in English original it's Trading Places with it's a classic movie with Dan Aykroyd and Eddie Murphy. The first one is an investment banker and a trader. The other one is homeless, and some rich old people make a bet that they can actually make the poor one rich and the rich one poor, and it's a sociological experiment that they both will fit in their new positions. Yeah? So the homeless can be an investment banker, and the investment banker will become a criminal homeless person. And at the end, it's all about It's frozen orange juice. Yeah? The final bet, the final trade is about frozen orange juice, which is a standardized underlying for futures on the CME. Yeah? Frozen orange juice. So we have pork bellies, orange juice, wheat, barley, natural gas, Brent oil, and so on. So all types of material and raw materials and commodities you can think of. And usually these will be traded, for example, on the CME, the Chicago Mercantile Exchange. And if you want to get a feeling of what is traded on the CME, just look it up on the internet. No? Similarly, losses can also result from the fact that required raw materials are delivered too late, not in the required quantity, only at higher prices than the prices calculated, or even not at all delivered. So in the first case, commodity risks generally arise if the prices for a commodity develop adversely in the future. That is, if a relevant commodity price rises on the procurement side or if a relevant price decreases on the sales side. Again, remember that this can hit you on both ends, at both ends. Take, for example, an energy company. The energy company, for example, will do what? It will buy gas and oil, it will burn it, and then it will produce electricity. Actually, also uranium is also a commodity. It's a nuclear power plant. So commodity prices can hit at two places. First of all, the prices for gas, oil, and uranium can increase, so you will be producing at higher cost. And the price for electricity can also go down, in which case you will sell electricity at a lower price. So this is commodity risk in two variants, and depending on the type of raw material or commodity, the respective market prices can fluctuate to different degrees and are subject to seasonalities. And if I remember correctly, on this next slide you can see some selected commodities. Ethylene dichloride, the spot price, is the blue line, and this is actually no big surprise. Ethylene dichloride is not, I don't know for what it is used. It might be for, well, it's not methylamine. I hope there's just a legal purpose for it. But prices don't seem to fluctuate that heavily. Then we have VCM. I think this is aluminum. Then the green line is uranium. And the purple line is butadiene, also the spot price, a chemical. And as you can see, all those prices are standardized, are normalized to 1 at the very start in 2004. And you can see, for example, the price of uranium increased by almost 10 times in just 3 years. So between 2004 and 2007, the price for uranium increased by 700%. Quite a steep increase. The price for ethylene dichloride actually stayed the same during the whole time. And I didn't even include gas, oil, because in that case, the prices would have gone up and down like a roller coaster. So, depending on the type of underlying, depending on the type of commodity, you will see more or less extreme price fluctuations. And depending on the type of business you are doing, you will need to have a more or less sophisticated risk management in place. Okay. Any questions concerning commodity price risk? So if you have no questions, I would say we'll stop here and talk about currency or so-called FX risks, foreign exchange risk, next week. Okay, thank you for your attention.